This is the money presentation. I'm not a financial advisor. This is not financial advice. Alright. If you're going to take away nothing else from this, live on less than you make. Track your exact earning and spending. Make a budget and stick to it. Get and stay out of debt. And invest in your future. If you learn nothing else, learn this. You have to do these things. Awesome. This is kind of the backbone of this whole operation, the order of operations. So this basically, I'm not going to delve into it now, but what this does is this lays out the order in which you need to do everything. So like every dollar you get from a paycheck will be delved out in this order. This will be the order that it will go. This is the overview. There's going to be 3 main categories that we go over: spending, managing your finances, and investing. You can read all of the subcategories. I don't need to do that. We'll get there. So we're going to start with spending. You have a credit score. Your credit score is a score associated with you generated by the 3 major credit bureaus, that being TransUnion, Experian, and Equifax. A good credit score allows you to get lower interest rate loans and the ability to lease, among plenty of other things. So, a credit score. It ranges from 300 to 850, but generally you want to be, this says 700s is good and 800s is excellent. I would say you should really be shooting for at least high 700s, like 750 and above. And just for some context, the average credit score is 715, but again, aim high. Alright, so what actually is a credit score? How is it calculated? What are the aspects that go into it? So 35% of it is your payment history. This is your on-time payment history, the percentage of all of your payments that you made on time. So basically, this just means never miss a payment. Your payment history should not, it should be 100%. There's no reason for it to be anything other than 100%. Even 98 or 99 is bad. You want to be making all of your payments. Not even just for your credit score, but just because you should be paying your credit card. Another 30% is credit utilization. This essentially just means you will have a given credit limit and you don't want to use too much of it. The number I've heard the most is about 30%. You don't want to be above 30% of your total credit limit. And one important thing to note that is across all of your credit. We'll get into a specific example of credit utilization in a second if it doesn't make sense to you. But basically you just need to know you don't want to be using all of the credit or even most of the credit that's available to you at any given point in time. Another 15% is the length of your credit history. Basically, you just want old credit. You want your credit to be established for as long as possible on average. So try not to ever close a card simply because that will bring down your average age. Now, if that card has a fee and there's no way to lower it to a different card and your only option is to close it, go ahead and close it. Don't pay a fee just to keep your credit history long. But if it's a free card, just let it sit there. Let it sit. Keep your average age as high as possible, because that's a part of your credit score. And then this is grayed out because it's really better if you don't think about it. But 10% of your credit score goes to both credit mix and new credit. So it's 20% total, 10% to each of those things. Basically, all this means is it helps you a little bit to have different kinds of credit, and new lines of credit will hurt your credit score. Realistically, it doesn't matter. Don't worry about it too much. Don't get a mortgage just to get a different kind of credit on your credit report. Just don't think too much about this one. That's why it's grayed out. I don't want you to think about it. Credit cards can be extremely useful, but they must be used very carefully and very intentionally. Always pay off your entire credit card balance in full every month. Don't think about a credit card as borrowing money. You're not borrowing money. Just spend as much as you could pay off in full at the end of the same. I mean, you should be thinking of a credit card as spending your money, not borrowing money. A part of this is turn on auto pay. It should be just automatically coming out of your bank account. Do not, for any reason, ever carry a balance on a credit card. It's just bad. It's among the worst financial decisions you can possibly make. Please do not carry a balance on a credit card. Another thing, if your utilization is high, again, we'll get to utilization in a second, but one thing you can do is just manually make an early payment. Even if you have auto pay on, you don't have to wait for the statement to actually be done. You can just go make an early payment, and that will lower your utilization. So credit cards have good protections and bonuses, but if you miss even one payment, none of that is worth it. So just understand, the most important thing is to pay it off in full every month. Do not carry a balance. There are good parts of credit cards. There are good bonuses, there are good protections, but not if you miss a payment. If you miss a payment, you're immediately paying more in interest, and you're paying more in the hit on your credit than you will ever get in a bonus. If you have little to no credit history, you will likely need to open a student or beginner credit card just to kind of get started and establish that credit history. Like I said earlier, credit utilization is your total utilization versus your total limit. So really, each individual card doesn't matter very much. If you see in this example, card 1 has a $500 balance on a $5,000 limit. So that's good. That's low. Card 2 has a $2,000 balance on a $2,500 limit. So that's well above that 30%. Like, that's high. And card 3 has no balance on also a $2,500 limit. So you may notice card 2 has a utilization of 80%. So that is high. You might think, oh, I need to pay that off. I need to make an early payment. 80% is too high. But actually, because it is your total balance across your total limit, in this example, utilization is only 25%, being 2,500 out of a total 10,000. So in this situation, the credit utilization is actually 25%, which is below that 30% where you would want it to be. So for beginners with little or no established credit, I would say the Chase Freedom Rise is the best option. It is a good card. There's automatic consideration for credit line increases and card upgrades, and it kind of gets you into that Chase system. So once you're past that point and you have a good established credit and you have a good consistent income, these are the 5 cards that really cover all of your bases. So there's the Wells Fargo Active Cash, the Wells Fargo Autograph, the American Express Blue Cash Every Day, the Citi Custom Cash, and the Chase Freedom Flex. If you can get these 5 cards, you're maximizing your cash back for the most part across all categories, notably without having any annual fee. Cards that do have an annual fee can be worth it. It's not necessarily an immediate no if a card has a fee, but often those cards will only be worth it for people that are really dedicated and intentional about maximizing their benefits. So if you're not going to be one of those people, if you're not going to be all travel focused and using points and being very intentional about the way you use it, this 5 card lineup works absolutely fine, and it'll get you just about the most cash back you can get. And here's a chart of that. So this is all of the cards, including the Chase Freedom Rise, and it just shows you in what categories does it get what cash back. What makes this lineup so good is that there's no annual fee for any of the cards, and it basically covers all of your bases. If you see pretty much every category, you're getting at least 3%, if not 4 or 5%. Another thing I would highly recommend is freezing your credit. So to do this, you want to create an account with the 3 major credit bureaus, all 3 of them, TransUnion, Experian, and Equifax, and freeze your credit on their websites. All of them allow you to do this for free, although they will make it difficult. They will try to get you to pay for things, sign up for things, whatever. All 3 of them let you do it for free. This prevents anyone, even you, from opening new credit in your name, which prevents identity theft. Whenever you have to open a new line of credit, simply unfreeze your credit temporarily. Most, if not all of them, have like a thaw feature where you can unfreeze it for a week or 2 and then it will automatically refreeze. Freezing your credit does not keep you from spending on your credit card or something. All it does is stop new lines of credit from being open. So you will be able to continue to use your credit card. It won't affect anything you currently have open, but it doesn't let you open anything new without unfreezing it. If you're young and or don't have much credit history, the credit bureaus often don't realize you're a person, so you can't make an account with them. Usually you just have to wait until you have a little bit of established credit, and then they will realize you're a real person and they'll let you make an account. If you are responsible enough to utilize a credit card, always do so. Always use a credit card when you can. Otherwise, use a debit card. Debit cards rarely have the protections of credit cards, so lock your debit card whenever you're not actively using it. Most banks, you can just go into the mobile app. There's just an option, just a switch you can hit, lock my debit card. I would always recommend having your debit card locked, because if your debit card is compromised and used, it is very difficult to get your money back. It is a direct line to your money, as opposed to a credit card, which is a direct line to the bank's money. So I would highly recommend using a credit card whenever you can, and always having your debit card locked. Cars. Do not buy a new car unless you are a millionaire. The value of a new car drops by an average of 20% in the first year of ownership and 60% in the first 5. What you should do instead is buy a reliable used car in full. This should be checked out by a trusted mechanic, and it should preferably be at least 5 years old, where you've taken the brunt of the depreciation. If you absolutely must finance a used car, follow the 23-8 rule. This means put down at least 20% of the full purchase price of the car, pay off your car in 3 years or less, and your entire car payment, including insurance and everything, should not exceed 8% of your income. Leasing. Do not lease a new car unless you are a millionaire. Leasing a car makes absolutely no financial sense. Car dealers are not in the business of losing money. Your payment takes into account cost of capital and depreciation. You will always end up paying more than it would cost to buy the same car and then resell it after the lease is done, because that's exactly what the dealership is doing, and they're still making money. Housing. How much house can you afford? Your total housing expenses should not exceed 25% of your pre-tax monthly income. If you and your partner both make $60K for a combined household income of $120,000, the 25% rule means your total housing cost should be $2,500 a month, including mortgage, property taxes, home insurance, and utilities. At current mortgage rates, that means you can afford an approximately $370,000 home, which would require a $74,000 down payment. Now that monthly number, that $2,500, would be the exact same if you're renting. And if you are renting, include things like renter's insurance in that number. So can you just rent forever? Home ownership is more work and more headaches than renting, and it can seem like it's more expensive overall. The ultimate benefit of home ownership, though, is that it fixes your housing costs outside of taxes and insurance. Especially over the course of a 30-year mortgage and beyond, locking in a payment is extremely advantageous. You will also benefit from appreciation at sale, so you will be building equity beyond just your payments. So I would highly recommend at some point buy a house. Fixing your housing costs is extremely important. Moving on to debt and interest rates. So you might have heard the term APR, annual percentage rate. This is the yearly cost of borrowing money. So for instance, borrowing $1,000 for 1 year at 10% APR, that means you're paying $100 in interest, and you'll have a total repayment of $1,100. Bad car loans can have APRs in the 10s or the 20s. Credit cards generally have APRs in the 20s and 30s. Payday loans can have APRs in the hundreds. And just for a reference, the overall stock market has averaged about 8%, accounting for inflation, in its entire history. So there's good debt. That is debt on an appreciating asset. This is almost exclusively mortgages. There's also good/okay debt, depending on how you use it. This increases your earning potential but does not itself appreciate. This is just student loans. If you use student loans responsibly, your earning potential is increased. So it can be worth it in the long run to take out debt for student loans. Bad debt is debt on a depreciating asset. This is car loans and most personal loans. So this would be like a boat, a trailer, things along that line, things that go down in value that you're holding debt on. And then there's also terrible, horrible, no good, very bad debt. Never do this. Carrying a balance on a credit card, taking out payday loans, taking out cash advances, and buy now, pay later. Debt consolidation. If you're carrying bad debt with very high interest rates, it can be advantageous to take out a personal loan to pay everything off. So you take out a personal loan that is the total amount of all of the debt that you're in, and you use that to pay everything off. This can bring down your interest rate and therefore lower how much you'll end up paying back overall, and it can simplify all of your payments down to just one. This is mathematically advantageous but must be used very carefully. If you consolidate your debt without changing your underlying spending behavior, you may just end up in more bad debt while you still have the consolidation loan. You have to actually address the underlying problem and change your spending habits. Remember that consolidation does not fix the debt or get rid of it. It just moves it around. You still have to pay it off just as urgently. Student loans. These can be high or low interest rate depending on age and whether they're private or federal. Absurd amounts of student loan debt, this being law school, medical school, etc. You should really consider if that debt is worth it in the long run. Your investing will be delayed significantly while you go through school and pay off your debt, taking away the best years of compound interest potential that you have. We'll get more into compound interest later and why this is so important, but basically you will have to contribute much more in order to keep up with someone who began investing earlier than you. The opportunity cost of student loans. The average student loan per borrower is approximately $35,500. If that amount is invested from age 22 to age 65, it could be worth almost $1 million adjusted for inflation in retirement. The average 4-year overall cost of attendance is approximately $120,000. If that amount is invested from age 22 to age 65, this could be worth almost $3.3 million, again adjusted for inflation in retirement. This is not to say that college and student loans are not necessarily worth it. Given the average student loan amount, you need to average about $15,000 more per year throughout your career compared to not having that bachelor's degree. So be intentional about what field you intend to enter after college and ensure that your degree is necessary. Lifestyle creep. 48% of people in the United States making over $100,000 live paycheck to paycheck. Even as people make more money over time, they don't end up with more money in their pockets because their spending increases accordingly. Having a budget allows you to control your spending and not have it get out of hand as your salary increases. As your pay increases, allocate more towards investing and saving before you start to spend more. This brings us to managing your finances. This is where we'll really start to delve into the order of operations. So step 1, the very first thing you have to do is pay your mandatory expenses. You have to live. This is rent, utilities, groceries. You need a roof over your head, you need food, you need heat, you need light, those things. These are your mandatory bills that you have to pay every month just to live. The second thing you have to do is make your minimum payments on all debt. And then you have to establish an emergency fund of a single month of living expenses in a high yield savings account. 4 is to take full advantage of an employer match in a 401k or 403b. 5 is to pay off all high interest rate debt. 6 is to establish an emergency fund of 3 to 6 months of living expenses in a high yield savings account. 7 is to invest further in retirement up to 20% of your income, utilizing an IRA first, then going back to employer sponsored accounts once the IRA is maxed. And then step 8 is do whatever you want. You can pay down low interest rate debt, invest in a taxable brokerage, invest in retirement beyond 20%, fund your children's college, save up for a large expense, have fun. What can you do at each step? If you're anywhere below step 5, this means all you can do is make your minimum payments, and that's basically it. You're not making any progress towards paying off your debt. If you're in this situation, there really should be absolutely no discretionary spending. This is a very bad situation to be in, and you need to get out of it as soon as possible. If you're in step 5, which means you're working through the process of paying off all of your high interest rate debt, some discretionary spending can be included, as long as your situation is manageable and you can still make progress on your debt with some spending. Once you're in step 7, which means you have that fully funded emergency fund and you're investing up to 20%, this is where you can really safely do big adult things and have as much discretionary spending as you want. This is where you can get married, have children, take significant vacations, save up for a better car or a house down payment. Once you're in step 7, you are financially healthy. You have your fully funded emergency fund, you're investing in retirement, you're setting yourself up for your future and for your retirement. That's where you want to be. Once you're in step 8, this is where you'd want to be before starting any kind of business or similar venture, because you want to be very financially stable before going into a situation like that. So I talked a little bit about what is high versus low interest rate debt. This is the chart. I would say anything below 3% is low. No matter your age, you should never feel hurried or pressured to pay off 3% debt. Once you're in that 50 plus category, I would say you can pay off debt less than 3% if it is important to you to be debt free in retirement. For debt less than 4%, this is again not something I would say anybody needs to pay off. But if you're in your 40s or 50s and you would feel more comfortable paying it off, it's something you certainly can do. For debt in the 4% range, if you're in your 20s, I would consider that low and I would not be worried about paying it off. If you're in your 30s or 40s, you could pay it off, just depending on preference. And if you're in your 50s or above, I would pay that off as you head into retirement. For debt between 5 and 7%, I would say you can leave that in your 20s. It really depends on your preference. But for anybody else in your 30s and above, I would say pay that off. That is high interest rate. And then for any debt above 7% for anybody, I would say prioritize paying that off. That is high interest rate debt, no matter your age. I mentioned a high yield savings account in the order of operations. You might be wondering what that is. So many traditional banks offer terrible savings account, earning very little interest on your cash even when the federal interest rates are high. Low savings interest rates mean that your money does not keep up with inflation, so as time goes on, your money loses spending power. Most high yield savings accounts are offered through completely online banks, which keeps their expenses low, allowing them to have such high interest rates. It doesn't really matter that a savings account is entirely online, because it should just be used to park an emergency fund or other large chunks of cash. High yield savings accounts allow your savings to keep up with or beat inflation while sitting idle. Pick a high yield savings account that is FDIC insured and has no fees or account minimums. If you're in debt, there are two main ways to go about paying that debt off. There's the snowball method, which is paying the minimum on all debts, then paying off your debts from smallest to largest with all remaining funds. So what this means is you're putting the minimum payment towards all of your debts, and then all of the money you have left over is thrown at your smallest debt until it's paid off. This will snowball the extra money that you have, because knocking out those smaller debts will free up those minimum monthly payments and let you throw that money at the bigger debts. The avalanche method is paying the minimum on all debts again, and then paying off your debts from highest interest rate to lowest with all your remaining funds. So this is, you're paying the minimum on everything, and then all the money left over goes first to your highest interest rate debt, no matter how much it actually is. The avalanche method is mathematically superior. You will pay back less overall because you're getting rid of the highest interest rates first. But the snowball method allows you to knock out minimum monthly payments and feel as though you're making more progress. If all of your interest rates are similar, you might want to consider the snowball method, because it will be easier to see your progress and you'll be more likely to keep going. An emergency fund. When things go wrong, a lot of people are forced to rely on debt to survive. An emergency fund protects you from having to rely on debt. Establishing an emergency fund of 3 to 6 months of living expenses can help if there's an issue with your car, damage to your home, or even if you're laid off and have to find a new job. Adjust how many months of expenses you have saved based on your risk level. So this is owning a home, being employed in an unstable field, or being self-employed, and you can even go beyond 6 months if you think your risk profile calls for it. An emergency fund should be held in a high-yield savings account. It should not be invested. It needs to be immediately accessible in the case of an emergency. Whenever you use your emergency fund, immediately work towards replenishing it. This goes back to the order of operations. So say you're in step 8 and there's an emergency and you use your emergency fund. This would put you back into step 6 because you no longer have that fully funded emergency fund. That's how the order of operation works. It's important with an emergency fund to define what an emergency is. It is very important that emergency funds are used only for emergencies. Some examples of non-emergencies are home renovations, bass boats, and Taylor Swift being on tour. These are not emergencies. You should not draw from your emergency funds to pay for this sort of thing. Additionally, if you're expecting to be without income or to have unusually high expenses, that being from moving or having a child, establish a separate fund for that. This should be on top of your emergency fund. If you know it's going to happen and you have time to prepare for it, it's not an emergency. You cannot draw from your emergency fund for something that is not an emergency. Moving on to budgeting. The average American is spending $738 a month on a new car payment. The average American is $6,295 in credit card debt. The average American is $37,338 in federal student loan debt. The average American is living paycheck to paycheck, and the average American is unable to afford a surprise $1,000 expense. Budgeting isn't about depriving yourself. It's about ensuring that you have control over your financial situation. It's important to make informed decisions about where your money goes, rather than letting it disappear to things that don't matter. People spend more than they think on things that don't matter. Going out to eat at restaurants, fast food, DoorDash, gas station snacks, Amazon, all kinds of shopping. Tracking your spending to the penny allows you to know exactly how much you spend and gives you the full picture of your financial situation. Once you know exactly how much you spend, you can create a budget to spend a consistent amount and to fix your spending habits. Budgeting is done by splitting up your spending into categories. Track absolutely everything, even cash and Venmo and Cash App, Zelle, to get your full financial picture. All of it counts and you have to track all of it. The idea is to understand exactly what you need to survive every month, then beyond that point, pay off debts beyond minimum monthly payment. This is the avalanche we were talking about. Whatever money is left after all necessities each month is put towards the largest interest rate debt until all debts are paid off. Once you're debt free, keep throwing that extra money at your emergency fund until you get to that 3 to 6 months of living expenses. Live like no one else so that later you can live and give like no one else. Sacrifice now to live better and give generously later. This brings us back to the order of operations. That avalanche method, where you're throwing all your leftover money at your debt, that is step 5. That is where you're paying off all of your high interest rate debt. Once you get to step 6, you're throwing all that extra money into your high yield savings account to get up to that 3 to 6 months of living expenses. You can do your own budget on a spreadsheet, or you can use a pre-made app. There's plenty of these. Good Budget, Every Dollar, Empower Personal Dashboard, Pocket Guard. Many of these apps can be connected directly to your bank and investment accounts, which allows the budgeting process to be mostly automated. However, I would recommend doing your own budget on a spreadsheet because it offers the most flexibility and keeps you involved with the budgeting process. The problem I find with automated budgeting is that you can ignore it the same way you ignore your checking account or the same way you ignore your credit card statement. Since it's automated, you don't have to be involved with it, and it can be very easy to ignore, which is why I would recommend doing your own budget and being involved in the process. If you know you struggle to save money, pay yourself first. Utilize automatic retirement deductions from your employer. Set up auto transfers to savings, retirement, or investment accounts whenever you get paid. Doing this puts the money into your future immediately without you really having the ability to spend it. Some general practice to go over. Never co-sign anything with anyone ever. No matter how much you trust them, co-signing any sort of loan or anything similar with anyone can quickly become a disaster for you. It is unbelievably risky. Additionally, making significant purchases or sharing finances with someone to whom you are not married, especially buying a house. Legally speaking, this is the same as co-signing. If they die, you now co-own with their parents. If you split, it's a disaster. Do not combine finances at all until you are legally married. Another thing, lending money to friends, family, or really anyone. This can easily destroy relationships. If you really feel the need to help someone, just gift them the money. If you can't afford to just give it to them, you can't afford to lend it to them either. Once you are financially stable, which is the step 8 of the order of operations, you can basically do 3 things with your money. You can continue to invest. This is putting money into a taxable account, into a kid's college fund, into real estate, other stuff like that. You can spend it. This is spending money on things you enjoy, hobbies, travel, luxuries. This is important. Don't just accrue money your whole life without ever enjoying it. All of these 3 things are equally important to your financial health. Once you're financially stable, you should be spending money. You should also be giving generously. One thing Dave Ramsey says, which I mentioned earlier, is live like no one else so that later you can live and give like no one else. This is giving to charity, supporting causes or people you care about directly, and tipping aggressively. I would recommend waiting until step 8 to donate money. You will be able to give more once you're financially stable than you ever could before. If you've ever been on an airplane, they always tell you to put on your own oxygen mask first. This is putting on your own oxygen mask first. It will let you donate more than you ever could if you're just going to perpetually be financially unstable. Your income is your most powerful wealth building tool. So how do you grow your income? Acquire in-demand certifications that increase your earning potential. This is especially important in constantly changing fields, especially tech-related. Leverage employers for advanced degrees or certifications. A lot of places will offer tuition reimbursement or specialized training totally for free through their employer. Actively look to move up within your current company. Take initiative, communicate your goals, develop leadership skills, record your achievements. One big thing is to constantly job search and negotiate, even if you're happy in your current position. This will help you know your true market value, use offers as leverage, and negotiate, especially if you don't need them. Job hopping is often the quickest way to increase your salary, especially earlier in your career. This brings us to the 3rd category, investing. My favorite. Should you be investing? If you recall the financial order of operations, you have to be in step 7 before you can start investing outside of your employer match. Try to get to this point as quickly as possible because it's very important to begin investing as soon as possible. If you have something that you're saving up for within the next couple of years, a wedding, a home down payment, etc., that money should not be invested. The market is too volatile in the short term. Back to the order of operations. You have to be in step 7 before you're investing outside of your employer match. What should you be invested in? Not individual stocks. You are not Warren Buffett. You cannot beat the market. If you insist on holding individual stocks, do so with less than 5% of your investment portfolio. What you should be investing in is indices. This includes the entire stock market, the S&P 500, the Dow Jones, the NASDAQ 100, the Russell 2000. You want to be invested in broad market indices. However, you cannot invest directly in the indices. You must use exchange-traded funds, ETFs. These are bought and sold like a stock, but they track whatever the underlying index is. This essentially allows you to be diversified into hundreds of companies without having to do any of the work yourself. There's also mutual funds, which are extremely similar to an ETF, but can be purchased with a dollar amount instead of by the whole share. These are often limited to the financial institution that offers them, which can make them difficult to transfer to another account if necessary. A mutual fund has a ticker that is 5 characters and ends in an X, compared to a stock, ETF, or REIT, which is 1 to 4 characters. Expense ratios. These are very important to keep in mind. They tell you how much of your investment goes to upkeep of the fund itself rather than actually going towards being invested. Many ETFs and mutual funds that track indices have reasonable expense ratios, less than 0.2%, and some even as low as like 0.05%. But active funds can be much higher, above 1%, which significantly eats into gains. An expense ratio of 1% lowers your average gains by that 1%. This makes a big difference over a long period of time. Most actively managed funds, which have those high fees, underperform the market anyway. Just invest in broadly indexed market funds. Investing versus trading. There is a difference between investing in the stock market and trading stocks. Investing involves buying something long term with the hopes that it will go up in value and or pay dividends. Trading involves speculating on something in the short term, trying to beat the market and make money quickly. Do not trade, you will lose money. Simply buy into broadly indexed ETFs, keep buying and never sell. Don't panic and sell when it goes down, that's how you lose money. Don't worry about waiting or trying to time the market, even if you think it's overinflated or that it can't go any higher. Timing the market. This is a case study where different people invest $2,000 every year between 2002 and 2022. So investing $40,000 overall over 20 years. Someone who invested perfectly when the market was at its absolute lowest every year would end up with $138,000. Someone who invested just blindly on the first trading day of every year now has $127,000. Someone who invested on the first trading day of each month, so they just spread it out over all 12 months, now has $124,000. Someone who invested when the market was at its absolute highest, they had the worst possible timing every single year, still has $112,000. Someone who chose to instead invest in treasury bills would have $44,000, and someone who didn't invest at all and kept their money in cash would have $40,000. Consider this if you have an exorbitant amount of money sitting in savings beyond just an emergency fund. You may think you're being safe, but you're really missing out on significant growth. Equities. Equities are just stocks. The younger you are, the more your portfolio should consist of equities, as they contribute the most to growth. You have plenty of time for the market to recover if there is a downturn. Some of the ETFs for this are VTI. This is the total U.S. stock market. This is every single stock in the U.S. stock market weighted by how big of a company they are. There's also VOO, which is the S&P 500 ETF. This is the 500 biggest companies in the U.S. Again, weighted by how big of a company they are. There's also VUG, which is Vanguard's growth ETF. This is generally a little higher volatility. It's a little bit more concentrated into those high cap growth companies. This is a chart of the S&P 500 since 1960. When you hear someone talk about the market in a broad sense, they're probably talking about the S&P 500. And if you'll notice, there are bumps, there are ups and downs, but for the most part, it goes up. International stocks. Although the US has significantly outperformed international markets in recent years, there have been times where international markets have prevailed. If you want exposure to this, consider an index fund that tracks the international markets. There's VXUS, which is Vanguard's total international stock ETF, and there's VWO, which is Vanguard's emerging markets ETF that focuses specifically on emerging markets. Some other investments you may hear about are bonds or CDs, which earn a set interest rate over a set time period. These are generally extremely safe, but underperform equities. They also don't do much to hedge against equities in a downturn. They can be good for people nearing or in retirement that need income, but you can also consider a stable dividend ETF like SCHD instead. There's also REITs, real estate investment trusts. These are very similar to an ETF, but they hold a portfolio of real estate rather than a portfolio of stocks. Most of the draw here is for dividends paid out from the rental income, although they are generally very tax inefficient. These can be good for people nearing or in retirement that need income. So certificates of deposits, CDs, and bonds, they allow you to earn a fixed interest rate on your money over a fixed time period, but they often have penalties for withdrawal before they have matured. They often offer higher interest rates than high-yield savings accounts, but this is not where emergency funds should be held because the money is not instantly accessible. CDs and bonds are good if you're saving up for something in the nearish future, where putting it in the market would be too volatile. If federal interest rates fall, CDs and bonds can be great because you're locked into a higher interest rate. However, if federal interest rates rise, the opposite is true, and you would have been better off in a high-yield savings account. Bonds can play a role in a well-balanced portfolio, especially for someone closer to retirement age. There's BND, which is Vanguard's total bond market ETF. Also consider, though, some other income-producing assets, such as SCHD, which is Schwab's U.S. Dividend Equity ETF. This has a dividend yield usually between 3.5% and 4.5% and has good capital appreciation. There's also O, which is Realty Income Corporation, which is very tax inefficient but pays dividends monthly and usually yields about 6%. These are some other quote-unquote investments you may hear about. Options. These are extremely risky financial derivatives, betting on whether a stock will go up or down, by how much, and by what date. Futures are also extremely risky financial derivatives in which an asset is bought or sold for a future date. There's also Forex, which is exchanging currencies, attempting to profit when one currency changes value with respect to another. There's also cryptocurrency, which is virtual currencies that are extremely volatile and entirely speculative. There's also multi-level marketing, which is a scam, infinite baking, which is a scam. Stay away from all of these. These are gambles and scams, not investments. Dividends. When you own a share of a company, you are a partial owner of that company. Companies often decide to compensate their shareholders in the form of dividends. Dividends are paid out monthly, quarterly, or annually, with quarterly being by far the most common. Index funds pay out the combined dividends of all of the companies that they hold. This serves as another way to compound your money, but generally most compound growth should come from stock price appreciation. Some people get really caught up in maximizing their dividends because they see it as free money, but really, especially as a young person, you should be focused primarily on capital appreciation, with dividends just being another little help you get towards compounding your money. Most, if not all, financial institutions offer a dividend reinvestment plan, which is usually called DRIP. This allows you to automatically buy more shares of stock with the dividends that stock pays. This is my favorite part: compound interest. This is a real Albert Einstein quote: "Compound interest is the eighth wonder of the world. He who understands it earns it, he who doesn't pays it." The core idea of compound interest is that interest accrues on interest, which leads to exponential growth. This works for you in the case of investing and against you in the case of debt. A $10,000 one-time investment earning an average interest rate of 8% over 40 years becomes $217,245. That very first year where you have just $10,000 invested, you made $800, which means you end with $10,800. But the key of compound interest is that in the second year, you start with $10,800, and that will also make 8%, which means that year you make $864, and that will keep compounding and snowballing on itself, where the next year you make $933, the next year you make $1,000, the next year you make $1,100, whereby year 40, you're making $16,000 in interest in 1 year. Still just on that $10,000 one-time investment you made 40 years ago. That is the power of compound interest. It is exponential growth. The most powerful part of the compound interest equation is time. So if you remember that $10,000 at 8% return, that turned into $217,000 from age 25 to 65, which is 40 years. If you wait until you're 35 to invest that $10,000, that exact same amount will turn into just $100,000, less than half, despite only taking 10 years off of your compounding time. If you wait until age 45 and now you only have 20 years, you now end with only $46,000. And if you wait all the way until you're 55, meaning you only have 10 years of compounding, it will only double to $21,000. The more time that compound interest is allowed to work, the more powerful it becomes. When it comes to compound interest, time is money. You want to start investing as early as possible. It is extremely important to invest young. Do not delay your investing. This is assuming 8% returns. If you invest $1,000 a month from age 25 to 65, you will have $3.1 million, with just 15% of that amount being money you actually invested. However, if you wait 10 years and don't start until you're 35, to get to that same $3.1 million, you have to invest more than twice as much, $2,287 a month. And now, more than a fourth of that ending money is money that you had to put in yourself. If you wait another 10 years and you don't start investing until you're 45, if you want to get to that same $3.1 million, you need to invest $5,600 a month. At that point, 44%, almost half of that $3.1 million, is money you invested yourself. If you wait another 10 years till age 55 to get to that $3.1 million, which remember, only took $1,000 a month from age 25, now takes almost $18,000 a month. And at this point, 69% of that, $2.1 million, you had to put in yourself to get there. Really consider this when going through something like law school or medical school. The time it takes to go through schooling and pay off your loans significantly delays your investing. You have to invest exponentially more just to keep up. $100,000 is 26% of the way to $1 million. If you're looking at investing $10,000 a year at an average return of 8%, once you get to $100,000, you'll get there after 7.4 years, which is 26% of the time it will take you to get to $1 million, despite you only being 1/10 of the way there. You'll see each $1,000 comes quicker than the last, despite not investing any more. Every single year you're investing $10,000. That does not change. And yet every single $100,000 comes much quicker than the one before, to the point where when you get to $800,000, $900,000, and $1 million, it's only taking you about a year to get that $100,000, where it took you 7.5 years to get the first $100,000. Compound interest grows exponentially. Getting that first $100,000 is very important and will set you up for success. Moving on to accounts and tax implications. Capital gains tax. When you make money from a taxable investment, you have to pay capital gains on whatever money you make, with tax rates being dependent on how long you held the investment. So there's short-term capital gains, which means you held the investment for less than 1 year. This is taxed as ordinary income. You will pay whatever your ordinary income tax rate is. And then if you hold for more than a year, it's taxed at the long-term capital gains rate, which is 0% if you make up to $47,000, 15% if you make up to $518,000, and 20% if you make more than that. Note that realizing capital gains, short or long term, raises your income for that year, and therefore changes your total taxable income. A taxable brokerage account has no tax advantages whatsoever, and you would incur taxes whenever you receive interest, receive dividends, or sell an investment for profit. However, there are no limits on how much you can contribute or withdraw to or from this account. And then there's the IRA, 401k, and 403b. All of these are tax advantage accounts, and they all serve very similar functions. The IRA, the individual retirement account, is unrelated to your employer. An IRA is an account completely funded and managed by you. The annual contribution limit of this account is $7,000 or $8,000 if you're 50 or older. A 401k is an employer-sponsored retirement account, often, not always, including a match. The annual contribution limit here is $23,000 or $30,500 if you're 50 or older. There's also a 403b, which is almost identical to a 401k, but for some public education, nonprofits, hospitals, and ministries. If an IRA, 401k, or 403b is labeled traditional, this means that the money contributed towards it is taken out of your income before you pay taxes on it. If you earn $60,000 but contribute $10,000 to a traditional retirement account, you will only pay income tax as if you earned $50,000. You only have to pay taxes once the money is withdrawn from the account, which will at that point be taxed as income. However, you can control your income in retirement based on how much you withdraw, so this will likely be lower than the income taxes you will pay in your working years. Note that you cannot withdraw from this account without penalty until you are 59 and a half. When an IRA, 401k, or 403b is referred to as Roth, this means that the money contributed towards it has already been taxed, but is completely tax-free when withdrawn. You do not pay taxes whatsoever on anything that happens in this account, whether it be dividends, interest, or capital gains. Again, you cannot withdraw from this account without penalty until you are 59 and a half. But, unlike a traditional account, you can withdraw the total amount you contributed anytime because it has already been taxed. There's also a health savings account, or an HSA. This is a savings account to pay for any medical costs. Similar to a traditional retirement account, the money contributed towards this account is taken out of your income before you pay taxes on it, meaning it lowers your taxable income. Similar to a Roth retirement account, you do not pay any taxes whatsoever on anything that happens in this account, whether it be dividends or capital gains, as long as you use it on medical expenses. It is completely tax-free when withdrawn. This has an annual contribution limit of $3,650. If you don't end up using these funds, you can withdraw them at 65, and it will essentially be treated as a traditional retirement account, meaning you will have to pay income tax on whatever you withdraw. This is a chart summarizing basically everything I just went over. So a taxable brokerage, it is money that has already been taxed that goes into it, and then once it's inside, it is the capital gains tax rate, whether that be short or long term. A traditional retirement account, or an HSA not used for medical purposes, is tax-free going in and inside, but is then taxed as income when it comes out. A Roth retirement account is the opposite of that. It is taxed as income before it goes in, and then inside and when it is withdrawn, it is completely tax-free. And then an HSA used for medical costs is called triple tax advantage. It is tax-free when you contribute, when anything happens inside of the account, and when you withdraw. Like I said earlier, the contribution limit for a Roth IRA is $7,000 per year, or $8,000 if you're 50 or older. Concerning your income, the contribution limit tapers off beginning at $146,000, and no contributions are allowed at $161,000. For a traditional IRA, the contribution is the same, $7,000 per year, or $8,000 if you're 50 or older, and the tax deduction tapers off beginning at $77,000, and no deductible contributions are allowed at $87,000. If you are above the contribution limits, consider a backdoor Roth IRA. This is a somewhat complicated technique, but essentially what you can do once you're above the income limit is contribute to a traditional IRA, convert that traditional IRA to a Roth, fill out some forms, and you have contributed to a Roth despite being above the income limit. So should you contribute to Roth or traditional? With all else equal, a Roth and traditional account should end up with the exact same amount, as it doesn't mathematically matter whether the taxes are paid upfront or when withdrawn, given that tax rate remains the same. What you have to consider is your current situation and the situation you expect yourself to be in during retirement. A general rule of thumb is that if you're in a tax bracket that has you paying above 30% in taxes, do traditional, and if not, do Roth. This is because you can control your tax rate in retirement, and you're likely to be able to get it much lower than that 30%. But you also have to consider how you think income tax brackets may change by the time you reach retirement. If income tax brackets go way up when you're in retirement, you'll be paying much more in taxes. So when in doubt, just do Roth. It will be completely tax-free, and you don't have to worry about that. Consider that the United States is in severe debt and that the deficit is constantly increasing, which will eventually lead to one of three situations. Either government spending will be decreased significantly, taxes will be increased significantly, or the United States will cease to be a country. It is likely of these three options that taxes will be significantly raised, which is why Roth accounts are generally preferred. Pay today's tax rates so that your retirement is free from future taxes. When considering retirement, you have to consider Social Security. Recall that the United States is in severe debt and that the deficit is constantly increasing. also consider that Social Security in its current state is a Ponzi scheme. So I would just say do not count on Social Security when planning for retirement. Odds are by the time you do retire, it will either be significantly decreased or gone entirely. Recall that getting your employer match is fourth on the financial order of operations, only behind necessary expenses, debt minimum monthly payments, and the 1-month emergency fund. This is because any money invested up to the full employer match is instantly doubled, making it a risk-free, instant 100% return on your investment. After you're out of high interest rate debt, continue to invest first in your IRA because you have full control over it and can choose your own low-cost index fund. The same is not always true of an employer-sponsored account. Once the IRA limit is met, you can then switch over to your employer-sponsored account until you've invested 20% of your pre-tax income overall. Do not include any employer match in that 20%. Retirement. Retirement is ultimately the end goal of investing. A general rule of thumb is that you need 25 times invested whatever you intend on living on annually during retirement for a safe withdrawal rate of 4%. This is to ensure you'll never run out of money, given that the market averages 8%. This would mean if you plan on living on $30,000 a year, you would need $750K. $50,000 a year, you would need $1.25 million. $75,000 a year, you would need $1.875 million. $100,000 a year, you would need $2.5 million, and so on and so forth. Life insurance. Life insurance provides a payout to your dependents if you die, which is extremely important if they are reliant on your income. There are two kinds of life insurance: whole life, which never expires, and term life, which expires after a given period of time, but is approximately 20 times cheaper than whole life. If you die at an old age, the payout from whole life insurance will always be less than if you had just invested whatever your payment was, making it an objectively bad investment. If you die at a young age, life insurance can be extremely useful for your spouse or children, as your investments likely are not enough at that point to cover your absence. Buy term life insurance until your investments are enough to cover your family upon your death, at which point you no longer need life insurance. As a summary, we went over spending, managing your finances, and investing. Again, these are the takeaways. If you were not paying attention, if you came out of this with nothing else, live on less than you make, track your exact earning and spending, make a budget and stick to it, get and stay out of debt, and invest in your future. Once again, the financial order of operations, this is the key. This is the exact order in which you should be doing everything. Pay your mandatory expenses. Make minimum payments on all your debt. Establish an emergency fund of a single month of living expenses in a high-yield savings account. Take full advantage of an employer match. Pay off high interest rate debt. Establish an emergency fund of 3 to 6 months of living expenses in a high-yield savings account. Invest further in retirement up to 20% of your income, utilizing an IRA first, then going back to employer-sponsored accounts once the IRA is maxed. And then do whatever you want. Pay down low interest rate loans, invest in a taxable brokerage, invest in retirement beyond 20%, fund a children's college, save up for a large expense. Have fun.